Commercial real estate cap rates are at all-time lows right now across almost every major asset class, and for real estate investors who currently own property, this is a really good thing. But for investors looking to buy their first deal or looking to deploy additional capital out into the market, in my opinion, this is probably the riskiest time to invest in real estate that we've seen in the last 15 years, with record high valuations that rely on continued record-breaking rent growth in order to pencil out. However, with that said, I'm also a believer that there are deals to be found in any market, and sitting on the sidelines saying that all properties are overpriced is just going to lead to missed opportunities. So to help you make smarter decisions and navigate what might be the hottest real estate market we've seen since the start of the Great Recession in 2007, in this video, let's walk through 3 ways to maximize your upside and minimize your downside in a record low cap rate environment, and why each of these strategies really matters. So the first thing on this list might seem obvious to those of you who have been in the industry for a while, but the math behind this is really interesting and not as obvious as you might think, and this is to focus almost exclusively on finding off-market deals to avoid the bidding process. With issues like rising inflation numbers, next to nothing yields on bonds, and pending tax policy changes, investors have flooded the commercial real estate markets over the past few years, driving up asset prices and driving down investment yields. And on properties that are broadly marketed for sale in today's market, you might be competing against 8 to 10 other legitimate offers, with the listing broker guiding you through multiple rounds of bidding and pushing you to stretch on your offer price at each stage of the process. And because there is such little room for error at these types of valuations, getting into a bidding war in an environment like this can be a really bad idea and can easily lead you to overpay for a deal during the bidding process, putting yourself at the whims of changes in the market in a very big way. For example, if you're bidding on an industrial property in Los Angeles right now where cap rates are as low as 2.8%, according to CBRE's H1 2021 cap rate survey, just a 50 basis point increase in cap rates in the market would drop your valuation by over 15%. And while that might not seem like much, if you consider that most real estate investments are financed with debt, if we assume a conservative loan-to-value ratio of 65%, a 15% drop in property value results in a 43% drop in equity value, which is a much bigger deal to investors in the project. However, this concept doesn't always work against you, and on the other side of the spectrum, this is where buying off-market deals at these types of valuations really starts to get powerful. On off-market transactions, you're able to avoid the bidding process altogether, and with that, you can also usually get some sort of a discount on pricing, which can immediately add a significant amount of value to your deal as soon as you close on the property. And to use another example to illustrate this, if you were to buy a multifamily deal in Austin today, where cap rates are as low as 3.25% according to CBRE, just being able to buy a deal at a 3.75% cap rate would result in a purchase price of more than 13% below market value. And again, at a 65% LTV ratio, the value of your equity in this scenario would increase by over 38% immediately upon acquisition without requiring any significant renovations, releasing efforts, or improvements to the property's operations. The moral of the story here is to pay extra attention to the price you're willing to pay in relation to what you could sell that property for if you immediately turned around and marketed the deal for sale. And the lower cap rates are in the market you're investing in, the more your initial basis in the property is really going to matter. Now, the second strategy on this list to manage your risk in a low cap rate environment is to use debt wisely and get creative on your terms. At first glance, it might seem like financing a deal at a lower interest rate than the cap rate will always end up increasing your returns, meaning that a 4% cap rate deal financed at a 3% interest rate would always result in a higher cash flow yield because of that debt. However, in practice, the interest rate itself isn't actually what's going to determine your cash-on-cash returns, but instead it's your loan constant, which includes not only your interest payments, but also your principal payments as a percentage of the loan amount. And at a 3% interest rate, if the loan amortizes over 30 years, that loan constant is actually 5.1%, which is significantly higher than that 4% cap rate, and this ultimately ends up dragging your cash-on-cash returns down due to a concept called negative leverage, which comes into play when your loan constant is higher than your cap rate. For example, if you were to buy a $2 million property at a 4% cap rate in an all-cash transaction, your cash-on-cash yield before any capital expenses would also be 4%. However, if you were to finance that property with a $1.5 million loan at 3% interest, amortizing over 30 years, your equity investment drops to only $500,000, but your cash-on-cash yield would actually drop by almost 300 basis points to less than 1%. And in a low cap rate environment, this is where getting creative with your debt terms really comes in handy by throwing an interest-only period into the mix to make sure that your cash flow yield actually improves as a result of the financing on your deal. So to use that same 4% cap rate and 3% interest rate example, in an interest-only scenario, that cash-on-cash yield on that $2 million acquisition starts to look very different, jumping up to 7%, significantly increasing your yield versus the unlevered scenario and making sure that you can make distributions to your investors during the first few years of your hold period and significantly reducing the odds that you'll have to issue an unexpected capital call if operations don't end up improving as quickly as you planned. Now finally, aside from finding off-market deals and negotiating interest-only periods with your lender, the last point on this list to keep in mind when investing in a low cap rate environment is to look for real physical barriers to entry in the markets you're considering investing in. Many of the metros seeing record low cap rates right now are also markets that have some of the most available raw land in the entire country, which can easily lead to overbuilding and excess supply and rents cooling off in the market very, very quickly. And with sub 4% cap rates often requiring annual rent growth assumptions of 5% or more just to get a deal to pencil and to hit a target IRR in the low to mid teens, investing in a supply-constrained market where building is both difficult and costly is one of the best ways to make sure that you're maximizing your chances of seeing those returns actually pan out. According to the CBRE Q3 2021 US Industrial Figures Report, Atlanta, Dallas-Fort Worth, and Phoenix were the top 3 markets in the nation for industrial square footage under construction, but these have also historically been some of the most overbuilt real estate markets in the country with lots of available land to continue building new product. And with cap rates in Atlanta as low as 3.25%, cap rates in DFW as low as 3.9%, and cap rates in Phoenix as low as 3.5%, if a ton of new supply starts coming online and demand in the market is suddenly satisfied, rent growth could easily come back down to more normal levels over the next few years, and this could lead to investors missing their return projections in a really big way in these markets. In a low cap rate environment, markets with a lack of available land to build on generally win out here, especially markets that are almost entirely surrounded by water, including metros like New York City, San Francisco, Boston, and Miami, since new supply is much more difficult, costly, and slow to bring online in these metros, making these markets much more likely to see sustained upward pressure on rents over the long term. Ultimately, this is honestly the most frenzied I've ever seen the real estate markets, but that doesn't mean there are no deals to be had, and I hope these principles are helpful if you're looking to stay in the game even at these pricing levels. And if you're interested in more training on real estate financial analysis and valuation, or you want to learn how to build out models from scratch for deals you're taking a look at, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, industrial, office and retail deals, and you'll also get access to private one-on-one email-based career coaching if you're looking to break into the industry and want some additional guidance and feedback along the way. And if you like this video and want to see more content on this channel on the current state of the real estate market, make sure to hit the like button to let me know, and let me know in the comments what kind of cap rates you're seeing in your market right now. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.